Good day and welcome to the Tourism Holdings Annual Results Presentation. Today's conference is being recorded. At this time, I would like to turn the conference over to Grant Webster, CEO. Please go ahead, sir.
Thanks, Renee. All right, good afternoon and welcome everyone, or good morning if you're, depending on what part of the world you're in. Thank you for attending this call and webcast for those that are looking online. We're going to be going through the investor presentation that we released this morning and obviously trying to allow some time for Q&A at the end. So here with me is Mark Davis, our CFO.
Good afternoon.
And we've got a couple of the finance team in here as well, but they're just making sure that we do the right thing. So let's dive into it. We're overall clearly very pleased with the result today. It's a strong performance. We've got growth baked into the coming year, and we think it's a real positive step towards our 2020 target of 50 million net profit after tax. Would make a note that we've made a real effort to anticipate a number of the questions, and we've disclosed more information again in this presentation than we have previously. We continue to do so. We believe the information that we've provided is certainly very comprehensive. We'll always continue to review the content of our disclosures. We need to always balance to make sure that we give you enough information to make investment decisions, but also maintain our commercial sensitivities. So one of the things that we often get asked is exact questions around yield and utilisation. We've tried to provide some indicators of that within the divisional results, and we'll talk to that and talk to what's driven some of the revenue trends, but we won't go into the exact numbers in detail. We'll also note just at the outset that there's a few currency impacts when translating earnings to New Zealand dollars, which have negatively impacted some of the results on an NZD basis, but we'll work through those as we go. So just slide 3 is just an important note because the Almonte acquisition does have an impact on this result in a number of areas: funds employed, profitability and revenue. We'll go through that in detail, but we'll leap past that to slide 5 and just talk about some of these financial headlines. So revenue up 22% to 340 odd million. If you take Almonte out, it was up 10%. Still very pleasing for us as a business. EBIT up 23%. Basically, the Almonte impact was nil at the EBIT line in essence. So good to have that 10% up in revenue and 23% up in EBIT, and obviously NPAT at 30.2. The pleasing element of that was clearly delivering over 30 million 2 years ahead of the target that we'd previously set a few years ago. Return on funds is something we talk about a lot in this business, and the focus is clearly working. Whilst 14.3 is down on last year's 15.1, again, that's the Almonte impact, so we'll talk about that some more as we go through. Earnings per share and dividends positive, and we'll talk more about dividend as we go through. So there are within this result always areas to improve, and we'll look to highlight those as much as the positives. So just flicking over to slide 6 and the trends that we have there. Pleasingly, the 2 points that I'll probably focus on the most are the EBIT margin that increased with or without Almonte, but looking at 15.5% EBIT margin, the highest we've achieved for quite some time, and a return on funds, if you take out the Almonte impact, of 16.7%. Very, very pleasing, and clearly we are in a revenue growth phase and continue to focus that as a key point for the business. Moving to the next slide, you'll see in the bridge that New Zealand rentals, as we've talked about in the release, has been the highlight within this result, with an increase of 8.8 million, close to 57% up in EBIT, and more growth to come out of New Zealand rentals. The USA numbers are not a concern to us, especially if you look at the underlying USD numbers, the investment that we've made into road there from a cost perspective, and the Almonte impact there. The tourism results, to be honest, disappointing, primarily Kiwi experience, well, only Kiwi experience in terms of the disappointing element. We'll talk about that in the divisional overview, and clearly the interest primarily reflects the investment in Almonte and the increased funds from that perspective. So what we deliver in terms of the key achievements on the next slide, these are the sort of the goals that we set at the start of the financial year and published with our theme of deliver. In terms of organic growth, we absolutely have achieved what we anticipated, and I think we're performing from that perspective. The inorganic growth, Almonte was obviously the core effort and energy and target for the year. We did look at other opportunities during the year, and we'll come back to growth and acquisition growth later on. My Way definitely progressed. We'll cover that in, again, the divisional results. But New Zealand is performing well from an owner acquisition perspective, and that launch into the US was critical. From a TCX or customer interaction and customer journey perspective, there is definitely more to come. We'll talk a little bit about telematics and what that's delivering, but there is more to come, and we're very excited about the future in that space. On a technology front, leading on from that, clearly we've got the investment in the likes of road trippers and developing the GeoZone product into there. We are moving forward with our booking system development, which we're in a redevelopment phase at the moment, and that should launch in FY18, which will be fully cloud-based. And we've got a ERP system upgrade as well that's occurring, as well as some work on marketing automation software as well. So lots happening in the tech space, and we're very happy with the way that it's working. Across all of that, we don't lose sight of the fundamentals of this business. We're a customer-facing business that has large volumes of activity that relies on good productivity within the branches and the network and knowing what we're doing on a fundamental basis. So our customer metrics have improved during this year of growth, improvement in staff engagement, health and safety, big improvements there. We've released our first sustainability report reflecting some positive work there, and we've stayed up to date and ahead of the guidelines from an NZX governance and code perspective. The next slide's return on funds employed, and I will talk about that within the divisional results, so we can sort of skip that one and move on to slide 10. In terms of the dividend at 11 cents, fully imputed for the final dividend, and that's just reflecting the increased New Zealand performance and the imputation credits that we have available. We don't see any point in holding on to those. There's nothing else to read into that at all. We see that we'll return to that indicative 50-odd% imputation moving forward, just based again on the balance of earnings from different parts of the world. The ratio in terms of an 84% payout is only very slightly down. Again, nothing to read into that. When you're talking 1 cent divvies, they make a 4 or 5% difference in terms of the payout ratio. So we're still at the upper end of our dividend payout ratio, which is 70 to 90%. Or not 75, is it? 70 to 90, I think. Capital expenditure on the next slide. No surprises in the year, and I think the more important thing that you'll be interested in is the FY18 CapEx, which is later in the presentation. So I'll skip over that and get into the next slide, which is our debt. So we're happy with the debt at 176 at year end. It's below what we had forecast. Clearly up nearly 100 million on last year, which reflects the Almonte transaction, as we've talked about at length. The debt to EBITDA ratio of 1.9 is under where we are saying around our 2 is where we're comfortable with. I'd reinforce again that we have heavily stress tested this under a number of situations and circumstances, and we are comfortable that we've got a CapEx profile, we've got a fleet age that can mean that we can control that debt very effectively if we run into a situation that we have to for whatever reason. So happy with that debt level. It will continue to come down over time on a year-end basis. It does peak at December. In terms of that funding, so we've moved to a syndicate facility. ANZ and Westpac have been with us for a long time and are very supportive and hugely knowledgeable about our business and the differences in terms of how we operate around CapEx and our needs and so forth and so on. HSBC coming in just adds value from our perspective, being a truly international bank, and gives us a lot more scope in a whole lot of different ways from a technology perspective and all sorts of different things. But all three banks very supportive of what we're doing, and we're happy with the current maturity dates, and we'll keep rolling those forward and staying ahead of that as time goes on. Right, let's just start to move on to the divisional review. In terms of slide 15 and the divisional edit, I don't need to go into that in detail. I'll end up repeating myself again. But it is of note that our revenue by geography is now roughly that 50-50 split. It will continue to grow rest of world versus New Zealand, as will the EBIT over time, and clearly the Almonte acquisition again has an impact on that. Okay, so by business. New Zealand, New Zealand Rentals, clearly a stellar result, growing in all aspects of the business. Revenue up 18%, fleet growth was circa 7%, so that meant that we had good shoulder season utilisation. Yield was up, not some of the figures that have been sort of touted around the hotel industry segment, but certainly good yield. Lines had a positive impact. We're saying, it's very hard to nail it right down, but we're saying there was about a $500,000 impact at the EBIT line, which was still positive at that time of year. We did still have some opportunities. Our R&M costs weren't quite what we wanted in the business. Not a major concern, not a major trend, just an opportunity for us to see that there's still opportunities to grow. And we see that there's still growth opportunities in the New Zealand Rentals business. So the outlook for New Zealand is positive. We are watching import vehicle sales from Europe very closely. We're getting more aggressive in our approach on imports ourselves. We don't see that having a significant impact in margins or returns. It's about us being clear that we're going after volume, and that's going to give us an opportunity to continue the growth overall, and hopefully we're expecting to maintain the kind of margins that we're achieving at the moment from an EBIT perspective and the kind of return on funds, but we would rather be investing in the value propositions and investing in price somewhat than continuing to grow those substantially. So from a competitor stand front, McRent has entered the market. They're a European rental operator. They tend to do joint ventures around the world. We understand that they're slightly less or less than 100 vehicles this year. Overall, when we look at the competitive landscape in New Zealand, in the large vehicle market, we actually see that overall it's probably looking about neutral or certainly below what visitor arrival growth is in terms of large vehicle numbers in the market. If you have a look at the McRent site, it's in East Tamaki in Auckland, and I think that site, the vehicles on it all sort of give us an indication that they're certainly sub-less 100 in terms of the vehicles they're bringing into the market. So in New Zealand, we don't see any major concerns. We think our scale and size continues to provide us with benefit, and we'll continue to make sure that we use that to the best effect that we can. In Australia, I think it's important to look at the Australian result in AUD just because of those exchange rate differences. So you're seeing rental income up 8, you're seeing vehicle sales up 10, and overall EBIT up 22% on the prior year. Our ROFE isn't ideal in Australia. I think there's 2 points that we're sort of making there. One, we do load this business pretty heavily with management overheads, and you could argue if you were completely independent that you'd be delivering a pretty good ROFE, and we sort of, you've got to balance that a little bit. I think the second key thing is that our closing fleet number was slightly higher than what you would generally expect, and that's 2 things. One, we probably slightly overfleeted in four-wheel drive fleet. That is a buyback model, so that exits very quickly, so it's not a long-term impact. But we grew our four-wheel drive fleet at the same time as all the competition growing their four-wheel drive fleet, and the market it was slightly oversaturated in the Northern Territories. Not a major impact, but certainly just affects that year-end funds number. But again, I'd reinforce the fact that we are bringing that back into line very, very quickly. And I think Australia in general still has good growth prospects for us. It's still on track with our broader long-term goals. So nothing of significant concern in Australia. We saw mild yield growth, but we saw good fleet revenue growth into the business, and utilisation pretty static overall for Australia, and it's run very good utilisation the last couple of years, so that's to be expected. Moving on to road beer. Again, really important, I think, to measure this on a USD basis. So fleet up about 10%, revenue up about 14%. That works well. Shoulder season utilisation was very positive. Yield okay, up just a very small amount, and that sort of set pricing that we operate with the road beer business well in advance. We're very happy with that business to continue to grow the fleet in the way that we are. We're first to fill in the market by what we see. We deliver, obviously, an outstanding return on funds employed at 28% for the year, and it's a good operating business. We indicated that we were investing in operating costs in road beer this year. We did, and that's reflected in the result, and all good, really, in terms of road beer and how it's tracking. Vehicle sales outstanding at 700, another new record for us, and reflective of a strong domestic market for vehicle sales in the US. Moving on to Almonte, and there's a few things to talk about from an Almonte perspective. For this half, it's clearly not the kind of period to measure it because it's the down season, we know all of that. But what are the core indicators, and try and anticipate some of the questions that you might ask. So for the first half, from a vehicle sales perspective, we exceeded our expectations. There is quite a chunk of older fleet, 2006s through to 2010 in the Almonte business. We had a target of selling those by September, October this calendar year. We are well on track with that. We're in sort of the low teens now in terms of how many we've got left. So that's very, very positive. We did expect and anticipate that we'd have to have a really strong wholesale strategy to move that kind of volume. We managed to get a much larger proportion retail than what we'd anticipated, and the team in Almonte have responded exceptionally well to the challenges that we've set them around vehicle sales and changing some of the internal processes and goals and targets. So they've done very, very well in that space. The rental market, the reality for us from what we see from an Almonte perspective is we have had an impact in rental revenue that's been primarily driven from the international market, not completely, but primarily, and that is two clear things that we're seeing in terms of indicators from the wholesale market and our general trends. One, there has been some uncertainty, volatility and unrest from the European markets in terms of the political situation in the US, and that has turned people off. We're seeing that in other indicators from airlines and hotels and rental car companies as well, so it's not something specific to us. And second thing is the currency impact. So we're seeing Canada absolutely boom again, and they've got a better exchange rate relative to the US at the moment. So you can say, okay, why are we seeing this in Almonte and not road beer? Two simple answers to that. One, road beer fills early. It's a strategy that it's had in its pricing for some years. And so we were taking a lot stronger demand pre-January this year, and that's where we started to see the impact. Almonte's indicators at the end of last calendar year were very positive as well, and it turned around in the first half of this calendar year. The second thing for road beer is road beer sits at a premium end of the market and tends to fill early anyway, so just from a volume perspective. So it targets it on price and it gets it from a premium position. So overall, in Almonte, some of that older fleet does relate in a sort of a one-off in nature gain, because we obviously, once those old vehicles are gone, they're gone. The margins that we're achieving on the rest of the fleet sales are very positive, and we're very happy with that and see positive indications moving forward, and we're definitely getting some real momentum on vehicle sales. In terms of the outlook and the actions for Almonte to recover that rental position, we're getting a really positive response in the wholesale market to our repositioning of Almonte. So clearing out that old fleet clears out a whole lot of issues. It clears out customer complaint issues. It clears out R&M issues. It clears out high refurb costs for sale issues, and it just frees up productivity. So when you've got a large number of fleet that's unproductive, and you've got to get to vehicle X, and you've got to move A, B, C, D, and E before you can get there, you clear that stuff out, and everything starts to flow more effectively. And there's really good infrastructure in Almonte to support that. So we will be pushing, and we have pushed, that Almonte will have its largest new fleet injection that it's had for over a decade. It does have the largest range in the industry in terms of what it offers the international market. It's got the best in quality infrastructure, and it's really taken the hit, taken the cuts, and it's rebuilding strongly. We've also got some extra efforts in the domestic marketing front as well. So we're starting to already see that recover, and we're looking forward to a very positive calendar 2018 year, which has some impact in FY18 and a lot more impact in FY19. All of that, in terms of the broader business model, the synergies that we're already delivering on a labour front and what we're looking at from a property perspective, give us confidence around the numbers that we've indicated for the long term for Almonte. So we see this as a very recoverable impact in our original expectations for this financial year, but nothing too concerning. So just quickly on slide 20, Almonte utilisation is definitely up. So we're already getting the fleet efficiencies, a lot more work flowing into next year. Return on funds accordingly is heading in the right direction. I've talked about synergies, fleet sales. I've talked about that 2017 calendar result, and we're looking, it's probably about $1 million-ish. We'll see EBIT impact of that rental revenue impact on this calendar year, the majority of that falling into FY18. And from a debt perspective, again, we're happy with where things are. So moving on to tourism and looking at slide 21, so Waitomo, actually good growth in visitor arrivals that's beyond, or PAX growth that's beyond visitor arrival growth to New Zealand. So in essence, still sort of gaining share. So Waitomo in a really good position. Things like the retail development that we did, producing really good ancillary revenue and flows through very nicely to the bottom line. We did have an impact with Kiwi Experience, which when you wash it all out was a little bit larger than what we had desired. It's in the sort of the several hundreds of thousands. It's not in the millions. It's not nothing. But the key things there, Kaikoura earthquake had a longer term impact than what we had originally anticipated. So that delivers high kilometres and higher travelling costs. It reduces add-on sales. And the other impact that we've definitely seen is the UK customer, which is the primary customer for Kiwi Experience, has spent less with the currency exchange rate that we've seen. So it's not that the visitation has been substantially down, but they have spent less in the activities and what they do in that business. So what does that mean from an outlook perspective? Kiwi we see is actually having a really good recovery from that position. We're now sort of year on year in terms of pricing, and what tends to happen is that sort of gets absorbed in the market and customers respond. But early indications are also that there may be more students doing gap years out of the UK. So university enrolments look to be down. So school leavers are looking more to gap years than they are going straight to university. That naturally tends to have a positive flow through to Kiwi, and our early indications for this coming high season are positive for that business. We're introducing a new booking system, which also will give us a lot more efficiencies as well. So nothing to panic about, not material in the overall result, but something again to disclose and fits into that category of us being pleased with the overall result for the company, but not completely satisfied. We'll look at the equity investment. So Action Manufacturing has performed very well, is very productive. It has paid down the vast majority of its shareholder advances to THL. It doesn't, all these equity investments don't come through into our ROFE calculations, but well above our benchmarks and really good demand into the coming year. So Action is well on track. We've got to keep looking at where to next and our partnering model to continue to enable that growth for that business. Just Go, great result overall. Strong growth in rentals moving forward, and vehicle sales is progressing well for that business, so more opportunities to grow. Road Trippers is on track broadly with our expectations. That's a business that is in a cash burn phase, and that's what we want as it continues to grow and its proposition is strong, and its core KPIs around user growth are showing that it's feel or that it's a good investment, and we think there's good opportunities. Moving on to slide 23, group support. We've still got MyWay in here. We've broken out the MyWay pre-tax loss for the year, which was $1.9 million. That includes the setup costs for the US as well, which launched in May. Broadly speaking, we are happy with the broader MyWay proposition. It continues to gain traction in the owner market in New Zealand. Very good commencement owner acquisition in the US. It is a much bigger market, obviously, but a much faster growth rate than what we had in New Zealand. So taking our learnings and passing them through to how we operate in that market. And we've got some demand opportunities in the US as we get to know that market a little bit more, but our indicators are positive. Broadly speaking, just a reminder, when we say the 2020 numbers and that NPAT 50 million target for THL, we have indicated in the past that we see these kind of drag investments at the moment being either a positive contribution or breaking even by that 2020 kind of a mark. So we are in a phase where we want to invest in them, it's working, and we'll continue to develop that. We have, in terms of a break-even proposition, we could move some of these investments to being cash positive if we wanted to, but you'd really constrain the growth opportunities with them. So we will continue to invest and continue to grow. So in terms of our FY18 focus, and if we look at slide 25, I guess I'd just reinforce that we're about building a global platform for the RV market to maximise the opportunity through the ecosystem. I've acknowledged in the shareholder review that sounds a bit like a buzzwordy kind of a sentence, but it's very real for us. So the kind of opportunity that we have in New Zealand, where we're growing our ancillary revenue in servicing and retail through MyWay, and that whole, every part that connects to the RV experience, is the kind of thing that we see developing in the US as well. And our Monte in particular has an infrastructure that can really enable that. So building a platform that connects and enables that kind of growth globally is absolutely key. We still see organic growth as per the current plan and that NPAT 50 million FY20. We still will look at acquisitions that align with today, but there's nothing in front of us right now. We'll look for acquisitions that enable us to leverage more of our IP and into that ecosystem. We will continue to invest and build in technology so that we can get more scale efficiencies, more centralized efficiencies as we operate a global platform. And we will continue to invest in innovation and design, and things like the electric vehicle pilot that we have underway is the kind of thing that we look to the future. We're prepared to invest a little bit now and see where that goes. So the key focal points for FY18 on slide 26, I think we've covered most of those, to be perfectly honest. I'd note that from a customer perspective, we're still really focused on deeper engagement, and we'll continue to review where all our joint venture investments go in terms of growing those over the next period. Sustainability, really pleased to be launching our first sustainability report. I encourage everyone to go and have a look at that, and we'll take any questions on that as well. We are on a journey with our sustainability initiatives. We are not where we want to be yet, but we've started, we're reporting, we've set some good goals, and I think it's going to be really beneficial moving forward. So let's flip through to slide 30, capital expenditure for FY18. Gross CapEx goes up to 200 million. That's inclusive of our Monte, where we are going to put, as I said before, more new fleet in, but that's reflective of us selling a lot more older fleet. So net fleet still comes down for our Monte as we had planned, and that's all about getting the right ROFE. And fleet sale proceeds, you can see, growing accordingly. Net CapEx of that sort of 40-odd million. If you want to think of it on a cash kind of a basis and adding depreciation, we are expecting to have positive operating cash flow in the next year as well. So again, when you look at that gross CapEx, you look at our debt number, you see that there's strong flexibility. You're sort of around 50% of that 200 million is fleet that turns over in a short period of time. So in terms of our guidance, if I haven't said it often enough, we're still focused on FY 2020. The range that we've put of 36 to 39 acknowledges the Almonte impact that we talked about in the calendar year. It acknowledges that Kiwi's coming off a slightly lower base, but we still see really good growth in New Zealand and Australia and the US in general, clearly. We are still winding through the peak season for Just Go in the US and Northern Territory, Australia. So we've still got a few things to wind out there and see where we end up. And we aren't in the peak booking period for New Zealand and Australia's summer, which is really starts September and moves forward. So again, more guidance and more definition around that target for FY18 at the annual meeting in October. I would acknowledge as well within that again, this is an NZD forecast, so there is some exchange rate impact again. If you look at July, just as an example, from a US perspective, our conversion rates was 0.76 versus 0.71 last year, so clearly you see there is some exchange rate impacts as well in terms of this result. So if I was going to summarise now, and sorry this has taken a little bit longer than maybe anticipated. So again, a good result for FY17, a very good result, well on track with our expectations. We're very, very pleased with that result. We're not satisfied in that it's perfect at all. There are definitely still areas that we have to work on within the core business. We are taking the phrase we've put out there, growing globally, and we're recognising that provides us with scale benefits and centralisation benefits. So in the US, for example, Roadbear has been a small, international-focused RV business. Almonte is a business that's been around for over 40 years with a strong knowledge base in the US and has really changed our presence in the RV industry within the US and been very pleasing from that perspective. We're creating a platform that does enable a further positive future for THL and more synergies and more opportunities in the broader industry. We're in a growth industry in tourism. We believe the RV segment is a growth segment. There's a really positive CNN article in the US about the growth of millennials into the RV segment and the broader growth of the industry. We believe in that and we see where the industry segment is going. We're careful about the risks that we're taking, but we are taking some risks with some of these investments and we believe that's the right thing to do. And so overall I'd say we're in a good space, but we're far from complacent. We're aware of some of the views of some parts of the investor community that think our NTA to value is out of whack. We believe we do have strong competitive advantages. We're continuing to grow those competitive advantages and we'll continue to use the likes of scale and innovation to keep that growth and protect our share and market share where appropriate. So we're in a good space. We've got more growth to come. If you look at that forecast, it's another 20 to 30% increase that we're saying for FY18. If you look at the forward multiple that we're operating on from a share price perspective, I think we still look good. And we're continuing to be able to see that growth whilst providing that dividend growth that we're seeing as well. So that's us. Renee, assuming you're still there, and I'm sure that you are, we'll hand over to you to open up for questions and manage us through those. Thank you.
Thank you. If you would like to ask a question, please signal by pressing *1 on your telephone keypad. If you're using a speakerphone, please make sure your mute function is turned off to allow your signal to reach our equipment. Again, press *1 to ask a question. And we'll move to our first question from Andy Bailey with Forsyth Barr.
Thank you, and good afternoon, Grant and Mark, and congrats on another great result. I've got a couple of questions here. The first is on the gain on vehicle sales, and I recognise the disclosure at the back of the presentation, slide 42, where you highlight a pretty strong gain on sale improvement year on year, and I recognise the disclosure's changed somewhat from last year in terms of associated vehicle sale costs. But can you give us a sense of really where that's arriving from, to what extent Almonte is contributing to that in terms of the sell down of the Almonte fleet, and to what extent New Zealand's contributing in terms of an uplift in the average gain on sale per vehicle?
I can answer that one, Andy. Yes, Almonte has had an impact in terms of lifting the average gain on sale in terms of a weighted average, but we got improvements across all the jurisdictions in terms of New Zealand and Australia. The average profit on sale went up, and you'll see that's reflected in the real depreciation rates, which we've shown at the bottom of that slide. So it's slide 42.
Great, and then I guess
so
the
vehicle sale market has been pretty strong.
I guess the question then leads on to how sustainable is our current rates in terms of average gain on sales, relative to your market understanding and some of the comments made by Grant with regards to going after volume, particularly in the New Zealand rentals business.
I think, look, as Grant said, it's a watching brief in terms of the vehicles coming into the country. And as I've said, we're the strongest player in the market. We're willing to potentially give up a little bit of margin for volume, but we're not seeing anything concerning at this stage in the market in terms of margins.
So should we a point that I'd add to that. So Andy, I'll just add a point. So if you take the likes of the Just Go vehicles that we bring down, we don't. Some of those go onto fleet, some of them go straight to sale. Any vehicle that goes straight to sale, we don't depreciate because it's obviously inventory. So that kind of product is just in and out, and so that we can play around with some of the margin on that. But we've said, since we've disclosed these real depreciation rates, we have sort of said, keep an eye on them and sort of we watch that as a key indicator of the issue that you're talking about.
Absolutely. So I guess then looking a year ahead, would you be surprised if that 10.9 average gain or $10,900, recognising changes in currency rates could have an impact, but does that go down or up?
I think it's pretty static.
Pretty static, yeah.
Yeah. Okay. Great. Then the next question I have is just around Almonte synergies, and I recognise you've kind of touched on labour and procurement and property synergies. Can you give us a sense of what changes have been made to date, and what we can expect in terms of changes over the next 12 months?
Yep. So as was sort of indicated, I'm probably just going to repeat what you've just said. So look, there have been some labour changes. There's been a number of leadership in key roles where we've had synergies and we've had people move on. So that creates we've delivered to that straight away. We've got some fleet synergies that we've created in between the two businesses, Roadbeer and Almonte. So that provides some benefit from a utilisation perspective and vehicle sale margin. So you can take some Roadbeer units and sell them retail through Almonte. That sort of helps from that perspective. And on a property front, we haven't actually combined any properties as of yet. We're working through some of that. There are some other properties that we are in the process of repurposing or exiting. And the repurposing is we see we've dived into some other opportunities in some of the sites that we have, opportunities for sales, service, storage, and my way type opportunities in some of those sites. So we're aggressively sort of getting either the synergy recovery that we expected and more, or we will exit some of those other properties. So in terms of synergies, we'd say we're absolutely on track.
Great, thanks guys.
Thank you. As a reminder, that is star one to ask a question. And our next question comes from John O'Shea with Ord Minnett.
Morning, guys. Well done on the result. Just a couple of questions from me. Firstly, in relation to the US business, I know you've given some indication on this, but perhaps if you could just give us a little more colour around sort of what's happening with the US summer bookings in terms of where they're at? The second thing is in relation to the tourism business in New Zealand, and obviously this year, as you mentioned, is sort of a lower than expected result. What are your expectations regarding sort of this year and how you sort of see that unfolding?
Yeah, so in terms of US, so road beer is on track with our broader expectations and its fleet growth this year. We have shown the acquisition numbers, 775 vehicles that were bought in the financial year. Some of those flow through into obviously this peak season's fleet, so an increase on the previous year there. Not significant, or we don't really see again much in the way of yield increases there. We're happy to just take that fleet growth and fill it. Our Monte is the one that, as we've indicated, we've said, anywhere up to, I don't think it'll be anywhere this bad, but anywhere up to sort of around 20% down on our original expectations. But one of the things with our Monte that I'd reiterate is it's 50-50 domestic international, and that domestic business comes late. It comes very, very late. So our sort of visibility of that and understanding of that as we're changing the fleet mix is something that we're sort of learning. So we may not have gone aggressively after domestic to the extent that we should have, but it's okay. It's all stuff that just gives us even more confidence for next calendar year. So as indicated, the broader impact that we'd see, we said that USD, that in the calendar year our Monte would be around $6.5 odd million, and we're saying there could be up to $1 million shortfall on that expectation, but we don't see it impacting the broader situation as we move forward. In terms of tourism, look, so Kiwi comes off a lower base, clearly. Waitomo is on track with the growth forecast that we had, and we still see good growth there, at or above international visitor arrivals for PAX growth. And Kiwi Experience, we do expect some rebound this year, but if we get back towards the FY16 result for Kiwi, we'd be pleased. Okay, so just for the purpose of clarity around the US, what you're really saying is that, that calendar year number you've given, and you're saying there could be some variability around, some uncertainty about the booking side up to the tune of $1 million. Is that what you're trying to say? Yeah, that's it. Yep. Okay, thanks. Thanks, guys.
Thank you. And once again, that is *1 if you do have a question today. We'll take our next question from Jack Crowley with FNZC.
Yeah, good afternoon, Grant, Mark. Just a couple of quick ones from me, if I may. Firstly, in terms of the Almonte fleet, what's the average age of that fleet now that you've flicked some of those older vehicles kind of between 2006 and 2009 years? And where do you see that tracking over the next couple of years? And secondly, in terms of the, I guess, the way that Almonte is integrated with road beer, you alluded to new vehicles coming into Almonte. Are they brand new vehicles, or are they coming from road beer? And I guess what's the extent to which kind of having Almonte as a retail channel for road beer, what's the extent that kind of lets you grow the road beer fleet? We've obviously kind of seen that tick up to unprecedented levels this year.
Jack, I'll try and answer a couple of those points. We've just had a slight volume issue here, so I don't think I got all of your question. But so in terms of fleet age, so Almonte, we have indicated that the average age of the fleet that's remaining is now 2.4 years, whereas the average age was 3.7 at acquisition. So we only see that improving. So it's a very good place to be in. The more the fleet is lowered, the R&M goes down, the refurb cost for sales go down, customer expectations are over-delivered. So it's a very good place to be in. The second part, I think you're talking about the road beer sales, the road beer vehicle sales, and the retailing some of those through our Monte sites. Look, it's small beginnings. So we've just taken a few in a couple of locations and seeing what we can test and do. Our Monte is a retail sales channel for RVs has been very focused historically on its very old end of the used product. So that's sort of how it's marketed itself, and that's the kind of customer base that it's had. So you go put a near new road beer unit there, and there's a whole change in marketing mix. There's a big change in the messaging for the sales team. When they've been doing years of, it doesn't matter that it's got 120,000 miles on it. Here's all the reasons why, and you put something with 15,000 miles and go, oh yeah, sell that as well. So it's a growing channel. It's a good opportunity because you take some of the retail margin that sits there without the infrastructure because it's already existing. So we'll look to grow it. It's not something that you should see as a substantive impact in any way, and it doesn't change the total number of vehicles for road beer. It just swaps out some of the wholesale sales for retail, but not of a substantial quantum. Does that answer your questions?
Yeah, good. That's very comprehensive. Thanks, Mike. Thanks, Grant. Just one more kind of related, if I may. So, if you think about the kind of the mix of vehicles that are coming into the Almonte fleet, and kind of where you'd like to see that go in terms of those that are ex-road beer and those that are new. Could you paint a bit of a picture of kind of what your vision is there, or is that again just a matter of kind of testing the waters before you kind of extend too far there?
No, I think that's a really fair question. So there's two things. There's two things. If you can sell for us, if you can sell everything from road beer and continue to grow the core rentals business from road beer and sell them all and not pass anything on to Almonte from a rental perspective, then that's the model that you go with. But if you can't, then you can still grow the rental model for road beer and pass some one-year-old vehicles through to Almonte, because Almonte's got the age proposition to do so. So our intent is to sell as many as you can through the road beer model, and then maybe continue to put some into Almonte. So there's a bit of a mix there. It's not so it's not substantive that flows down to Almonte at the moment, but look, over time it could be 100, 150 odd vehicles, potentially over time. But that's sort of where that sits. In terms of Almonte and its vehicle mix in general terms, we've got some more work to do now on the total mix between road beer and Almonte, maximising all those opportunities. So if there were 50 odd vehicles that you wanted to pass through, what would that vehicle type be that fits a longer age proposition that's in Almonte, so forth and so on. The other thing that we've dug into, we've done, as we do with our focus on ROFE, we've done a 5-vehicle ROFE model as we've dived into some of the metrics to a greater degree than you can in due diligence, and really that's changing some of our fleet mix as well moving forward, where we can really go, we look at things in a different way to what Almonte has historically. So very ROFE focused, very focused on what categories perform and why, and that's changing our fleet mix somewhat moving forward.
Got it. That's very useful context. Thanks, Grant.
Thank you. And at this time, there are no further questions in the queue. I'll turn the conference back to our presenters for any additional remarks.
No, so in summary, I guess just the closing comments. Thank you, everybody, for coming on the call and looking at the presentation. There's a lot of information there. Feel free to come back to us with any questions as you go. Just reinforce that we're very pleased with this result. We're very focused on that 2020, and we've still got some opportunities to improve along the way. So, again, we think we're in a really good spot, but we're not complacent about that. Thank you again very much. And thank you as well, I'd have to say, to Mark and the finance team who have delivered the shareholder annual review in its final form today, along with all the other materials, and we've delivered a sustainability report as well. So I think it's a good effort. Thank you all. Thank you, Renee, for guiding us through.
Oh, you're welcome. This does conclude today's presentation. We thank you for your participation.